Compound interest. Compound interest is earning interest on both your principal and the accumulated interest. If you invest $1,000 at 5% per year, you earn $50 in year 1. In year 2, you earn interest on $1,050, not just $1,000. In other words, your amount becomes $1,102
as opposed to $1,100. In year 3, you'll have $1,157 instead of $1,150. That interest on interest effect is insanely powerful compared to normal interest. It's like interest on steroids. Over time, this compounding snowball can dramatically grow your wealth. Starting early maximizes its power. Every year counts.
Stocks, or shares, represent ownership in a company. When you buy a share, you own a small fraction of that business and can claim a proportional piece of its assets and profits. Stock prices move up and down on exchanges based on supply and demand, letting you profit by selling at a higher price or by receiving dividends when companies distribute earnings. Please note that the stock market can be risky. You can make a lot of money if you know what you're doing, but at the same time, you could potentially lose a lot of money if you don't. Imagine this. You buy 10 shares of NVIDIA at $150 each, a $1,500 total investment. If NVIDIA's stock climbs to $160, your holding is now worth $1,600, netting you an unrealized $100 gain. By owning 10 shares of NVIDIA, you now own roughly this percent of the company.
SIP, also known as a systematic investment plan, is an easy yet powerful investment format.
It allows you to invest a fixed dollar amount in a chosen asset, mutual fund, ETF, or even an individual stock at regular intervals, typically monthly. If you're investing through an SIP,
You don't have to worry about market ups and downs. It automates your contributions, uses dollar cost averaging by buying more shares when prices dip and fewer when they rise, and taps into the power of compounding, since time plays a major role in an SIP growth.
you simply keep investing monthly. For example, think of an SIP as a plant that you grow by watering it no matter the weather. Imagine the monsoon as a market rise and the extreme summer as a market crash. You continue watering the plant every season, just as you continue your SIP regardless of market conditions. Over the years, with patience and care, that modest plant could grow into a flourishing tree, bearing the fruits of long-term returns and financial growth.
Net worth is the difference between everything you own, your assets, and everything you owe, your liabilities. To calculate it, add up your cash, investments, property, and other valuables. Then subtract any mortgages, loans, and credit card balances. Tracking your net worth over time helps reveal whether your financial situation is improving or deteriorating, and it can guide smarter decisions around saving, spending, and reducing debt. Simply put, your current savings, cash on hand, investments, and assets like property make up your net worth, as long as you don't carry any debt or mortgages. Suppose Timmy has total assets worth $475,000, and his liabilities, including mortgage, student loans, and credit card debt, amount to $225,000. To calculate his net worth, we subtract his liabilities from his assets, resulting in a net worth of approximately $250,000. Ah, inflation, the main villain of the financial saga. Ever noticed how you could once buy an entire cart of groceries with just $100, but now that same $100 barely covers 2 or 3 items? Yup, that's inflation at work. Inflation measures the rise in consumer prices over time, reducing your money's purchasing power. At 4% inflation, $100 today buys only about $96 worth of goods next year. Savers relying on fixed deposits lose value if returns lag behind inflation. If you had $1,000 in the year 2000, it would be equivalent to about $1,866.81 in 2025 in terms of purchasing power, based on an average annual inflation rate of approximately 2.53% in the US. By the way, inflation rates vary from country to country.
Bonds are loans you make to governments or companies. You buy a bond for, say, $1,000, and the issuer pays you regular interest. If the coupon is 4%, you get $40 a year, until a set maturity date when you receive your $1,000 back. Bond prices move inversely to market rates. When rates rise, bond values fall. Since bonds are considered safer than stocks, they offer steady income and help reduce portfolio risk. Think of a bond like lending your friend $100 so they can make crappy videos like this. Every month, they pay you $4 for borrowing your cash, that's the interest, and after a year, they give you back your $100. In bond terms, you're the lender and the government or company is the borrower.